views on collateral? What do you think from your point of view is an issue there?
Yeah, I'm sure tying in on comments that have been made earlier in the evening regarding the this concentration of so much exposure at the CCPs. One of the elements of Basel III, too, that was an oversight in Basel II, or whether or not it was an oversight or not, it just wasn't there in Basel II, was that you didn't have to hold capital against your CCP exposures. So now what we're going to see in Basel III is that you do have to hold capital against your CCP exposures. So this is just going to be another space, in addition to having talked about capital being held against the CVA VAR, you're going to now hold this additional capital against all of the cleared exposures that you have to your CCP, again, making this whole entire business more expensive. And is something that I think, again, from a practical standpoint, when you look at what firms are going to have to do in the counterparty space, historically, and that being the last 20 years, CCPs were viewed as risk-free. So counterparty units, unlike a market risk group, which did have to source into all of its VAR systems futures that were being cleared at numerous CCPs, counterparty risk units traditionally did not, because you weren't calculating counterparty exposure against any of the CCPs. So there's a lot of infrastructure work that's going to have to be done in these risk management units to be able to quantify this exposure. And again, just really speaks to the costs that are increasing in this space. And then I had one other comment on leaving these OTC books that will still exist, and they absolutely will. I agree with you that it's going to be years before all OTC derivatives can clear. Just looking at the timeline that it took to get this first, this 3-year window to get this initial phase, which just went live on March 11th, clearing. And what you're leaving these firms with in the counterparty risk space are all the vanilla, very easy to price swaps are going to the CCPs, and then your OTC books are left with the less liquid, less vanilla transactions. And I think there'll be unintended consequences there in terms of the intent being to have reduced your counterparty exposure, but you're going to be left with these much less liquid, if you will, OTC books that just won't clear for a while. And there's the non-cleared IM margin rules too, where we're still waiting to see how those will play out and how much additional margin firms are going to have to post to each other for just holding an OTC book. And really those laws would overwrite what we think about in our traditional is the CSA space, and the non-cleared IM rules would prescribe how much margin needs to be posted between OTC counterparties, again, increasing the cost.
Yeah, there's actually a BIS study that recently was done to see what the impact of the exact same thing Tammy was talking about on the margin requirements across the industry. So the QS study says that there's $1 trillion impact for the OTC book with respect to the margin requirements, additional $1 trillion. So they're coming up with ways to deal with that by defining thresholds up to which you don't really have to exchange initial margin, and as well as creating some de minimis amount for exchanging variation margin. So there are ways in which they're trying to minimize that impact, but clearly, that's still a subject that hasn't been solved.
Thank you. Deborah,
I was just going to say there's also a reduction in the quality of the collateral that has to be posted that's been put forth, and that's maybe makes it easier for people to find collateral, but may exacerbate a bad situation.
Okay, thank you. I guess it leaves me now to talk about biggest issue in quantitative space, in calculation space, and I pick wrong way risk. And there most interesting kind of feature, and Doug probably will correct me, that there is not only wrong way risk but also right way risk. And yes, when I talk about wrong way risk, I talk about both. Though regulators are concentrated on adverse, kind of on only one side of this risk, but when you calculate this difference between zero correlation and some correlation between market factors and default, you of course do this for both positive and negative kind of effects. So you should calculate both right way risk and wrong way risk. So when I say wrong way risk, I mean both. So what's interesting about this, regulators kind of separate wrong way risk in two categories. They are talking about specific risk or trade-specific risk and systemic risk. An example of trade-specific risk is when you buy CDS protection, or when you buy the put option from some counterparty which is closely correlated with the reference name. Nobody probably will do this from reference name, but doing this from close is also probably not that how should I say, smart. Regulators just say that if these kind of trades happen, then they just, for capital purposes, for capital charges, they just assume that the whole notional is at risk. So that's their kind of treatment of specific risk. But there is also systemic risk where counterparty default is correlated, or there is dependency between counterparty default and market factors. And you can think about FX, for example, and if you are in cross-currency swap with some either sovereign or some big bank in emerging market, and if you receive dollar and pay local currency, and this bank default, then very high probability exists that the currency of this country devalue, so you will be in the money at the same time when default happens. So this is the classical kind of systemic example of systemic wrong way risk. So the regulators, Basel III actually strengthens this wrong way risk regulations, and emphasize how important is this, though they are not really specific directions how to do this. But from calculation point of view, is there a real kind of difference between specific risk and systemic risk? If you think about this, so you basically have to correlate either credit or equity for kind of a specific risk, or FX for systemic risk with counterparty default. When you simulate these assets, they basically, from kind of Monte Carlo point of view, they are the same. So there is not really much, unless you kind of concentrate only on one trade, then otherwise you have to do this together. And from calculation point of view, there is no difference. Another thing is what type of correlation we talk about. Is it correlation between movement of equity, movement of credit spreads, and FX? Probably not. We have to think about correlation between market factors, and now by market factors I mean everything, including credits, equities, reference kind of or close to reference equity and credit, and default of counterparty. This is the biggest challenge, how to create correlation which basically picks up this strong kind of type of dependency. We are familiar with this kind of strong dependency in credit world. This is kind of normal copula correlation, which is correlation between times of default. And this is different from correlation between spread movements. So when people started trading tranches, there were first attempts kind of to price this using kind of Monte Carlo with spread movements and correlate them. But it failed because you cannot really, you couldn't calibrate to market tranches. So that's where normal copula came from. So this type of normal copula, but now it's not kind of correlation between default times, a correlation between default times and market factors, including specific and systemic, if you wish, market factors. So this is kind of the second challenge, create unified system which will be treating this correlation between default normal kind of type kind of correlation. And the next challenge will be how to calibrate this, because definitely there is no historical data for this, and there is no trades which are based on this correlation. Unlike tranches, which gave you kind of base correlation and so on, there is absolutely no information for this type of trade. So probably the best solution will be to have some kind of model, maybe Merton type, Merton-like type of model, which converts kind of spread movements or asset movements, correlation between asset movements into correlation between defaults. That's one of the ideas. So that's kind of very interesting things, very challenging things, and I have like 5 more minutes, and there is advantage to be the last speaker, so I will talk probably, I know we all agreed to talk only about one topic, but I'll try to squeeze in another one, FVA, and the reason is also that there is absolutely no, these days there is no CVA panels without FVA discussion, right? So we want to be as everyone else and give a little bit of our thoughts about FVA and debate. And so I will start to telling what I think, and then I hope Doug will continue and comment on this. So the whole FVA debate, I just remind you, started with Hull white paper in July, where they proposed, first of all, they said this is absolutely kind of risk-neutral pricing. It cannot be a part of risk-neutral pricing. It should be excluded from everything. It shouldn't be added to price, and it shouldn't be transferred to the desk. So basically, their arguments were that if you hedge, as we assume in risk-neutral pricing, then your spread should kind of diminish to zero, spread as a company, spread at which you fund your position should go to zero. So basically this hedge makes you riskless company, so your FVA will be zero. So we know this argument doesn't really work for separate trade. From my, and then I believe in October they wrote another paper where they kind of gradually agree that, yeah, you have to consider this FVA as a separate cost, and then you have to try to charge traders, and then it all depends on the relationship between Treasury Department and traders, if they agree on this or not. And I kind of agree with their later point of view. I consider this as market incompleteness. We are familiar with other market incompleteness, like price jumps, like hedge cost coming from transaction costs, right? Each of this market incompleteness makes, like Black-Scholes price, for example, incorrect. You need adjustment to this. And the reason between the FVA and other market incompletenesses was that FVA is incompleteness which is more or less easily quantifiable. So FVA you can describe, and this can be added as adjustment. While if you have transaction cost in hedging, or if you have prices, jumps in prices, it's hard to basically to calculate this adjustment. So now we have this adjustment. The question is what to do with this, right? So once again, there is risk-neutral price, fair price, which includes CVA and DVA. People agree on this, that this kind of symmetrical. And now you have completely unsymmetrical piece, which comes from your cost. So should you pass it to the counterparty, or should you kind of keep it with Treasury Department and kind of aggregate for the whole bank, or should you charge your traders and make them trade like choose the trades which have kind of minimal FVA? And with this question, I probably pass to Doug. What do you think?
Yeah. I think that the use of an FVA as a charge against a trading desk is something that will create discipline in the traders, largely because the way that you really arrive at a problem with FVA is in situations where you have an uncollateralized party on one side and you have a collateralized party on the other side. And in that case, so take, for example, a swap where you're paying fixed in an upwardly sloping yield curve. As time progresses, the curve, the forward rates will indicate that you will be owed money on that trade over time, and therefore you'll be posting collateral on your hedge, and if you don't have a collateralized counterparty on that particular trade, you will have a funding deficit as a result. So what's the problem with having a funding deficit? Well, I mean, in all the things that we've talked about, run on bank was mentioned. If there's a run on bank, you don't have funding. And if you don't have funding, then if you have a collateralized counterparty on one side and an uncollateralized counterparty on the other, you're going to fail. So charging the desk for that and potentially having the desk pass that on, and actually going out and getting funding for yourself based on what your forward expected funding profile looks like, I think is a good discipline for the market.
We're amazingly punctual, so we are right on time.
I just wanted to comment on I wanted to comment a little on runway risk, which
okay, great. Yeah,
relates to Dimitri's thesis on incompleteness in markets. So take for example a company that is in the natural gas business. So they produce natural gas, or they produce a product that is very closely correlated with natural gas, and you buy gas from them. That trade should be a right-way risk trade for the bank. You're buying something that should go, when it goes up in price, the company that you're buying it from should be doing better. And when the price goes up, because you're buying it at a fixed price on a forward basis, they're going to owe you money when the price goes up. Because we do have incomplete markets, that is not necessarily right-way risk. And the reason is that the hedges that you need are constrained in other ways. So if there was a completely liquid CDS market where there was no friction whatsoever, that would be a right-way trade. However, there are things called risk concentration limits that people have, and they are unable to continue to write CDS protection to you, even though they may also believe that spreads will tighten as the price goes up and as their risk increases, or as the bank's risk increases. We saw this happen in a situation where a company that was highly levered and in a rising gas price environment, spreads moved to multiples of what they were. So it was a very risky credit to begin with, and as their business conditions presumably improved, their spreads widened dramatically. So beware of the assumptions that are made around right-way risk, because it's not always right.
Thank you very much. Very interesting comment.